Students, I am Namrata Hampiholi from Department of Commerce and Accountancy, KLS GCC Belgavi. So in yesterday's class we have started with our second unit, that is capital of a company. So wherein we have seen the meaning of share. Now moving to the next concept here is features of share or shares. So here the share capital of the company is divided into the units and these units are called as in shares. So shares will form a capital of a company and each share has its face value. So in yesterday's example we have seen the share certificate of a Reliance company wherein it was printed the value of that one certificate, that is one share is 10 each. So that is called as a face value. So that contains certain value. Then here that share cannot be divided into the fractions. Then those who purchase the shares, it has given rights and liability to that particular shareholders. That is, whoever purchase that shares of the company will receive some rights and liabilities. And the share is movable property. That means here that can be transferred. So these were the features of shares. Then coming to the next concept here called as stock. So here stock is a set of the shares put together in a bundle which can be split into the fraction of any amount without regard to the original nominal value of the share. So in simple words, here the shares when they are put together they become a stock here. So here stock is the capital which is formed from the fund and it can be divided into the desirable amount. So when we compare it to the shares, here shares may be partly paid or fully paid up, but when it comes to the stock must be fully paid up. Then here the company can issue shares directly to the shareholders, but when it comes to the stock cannot be issued directly to the shareholders here. The shares have to be converted into the stock. Then here the stock doesn't have any any face value or the nominal value as the share has here. So here the stocks are not even numbered and here stock can be divided into the unequal amounts. And here the stock can be transferred in the fractions, wherein when we compare it to the shares cannot be transferred in the fractions. So this was about the stock. Then coming to the type of shares. So here under section 43 of Companies Act 2013, the share capital of the company is divided into the two parts, namely equity shares and preference shares. So now let us look into the equity shares. So what do you mean by here equity shares? So here equity shares are the main source of the finance of a firm. It is issued to the general public. Equity shareholders do not enjoy any preferential right with regard to the repayment of the capital and dividend. Here they are entitled to the residual income of a company, but they enjoy the right to control the affair of the business, and all the shareholders collectively are the owners of the company. So yes, so these shareholders are the person who invest in the equity shares. So when they invest into the equity shares, they are contributing to the ownership of the company here. So here there are certain rights which are enjoyed by the shareholders when we compare to the preference shareholders. So here shareholders get some of the rights such as a voting right. That is when there is a time for selection of the director of the company and other legal matters or with the other important decisions regarding to the company. Here the shareholders get a right to vote or to keep their review about the matter. So here equity shareholders during the winding up of the company, that is during the closure of the company, the shareholders do not enjoy that right which the preference share enjoy, because during the winding up of the company they are the last person when the company give preference for the repayment of the amount. Now let us look into the features of the equity shares. So these are the permanent in the nature, that is the shareholders remain up to the winding up of the company, that is until and unless your company is closed, these shareholders remain with you all, that is the shareholders will be till the winding up of the company. Then here they are the actual owners and they bear the highest risk. So the shareholders bear the highest risk of the company. That is whatever in the losses or the profits in the business are bared by them. So even in the case of a loss also they bear the highest risk. Then here these equities are transferable, that is the ownership, that is whoever is holding the equity share that can be transferred, so with or without consideration to the other persons. So the return what we get here on the purchase of equity share, we call it as a dividend. That is like if you are purchasing any shares of a company, you become a shareholders. And what is the benefit of that? That is you are getting a dividend. That is a part of profit. That is whatever the profit the company is earning, the part of it they are paying it as a dividend to the shareholders. So here the rate of the shareholders is not fixed here, that is rate of dividend which is given to the shareholders is not fixed here. So here dividend payable equity shareholder is an appropriation of the profit, that is out of profit whatever the company has earned, that part is going to be paid to the shareholders, but at what rate they should pay is not fixed. So whenever there is a higher profit, whenever there is a good profit, then the good returns will be given in the form of the dividend. But whenever there is a profit decreases, then the rate of dividend given will be less. Then here equity shareholder have right to control in the affair of the company, that is they have a voting right here and they are taken their decision is taken into the consideration when in matters of the, that is to the control of the affair of the company. Then here liability of equity shareholder is limited to the extent of their investment. So here when it comes to the liability, it is a repayment of a debt while closing up of the company, we can say. So at that time shareholder have to repay only to the amount they have invested. So here the liability is only limited up to the extent of their investment. How much they have invested, up to that they are liable to pay and not beyond that. So next coming to the types of equity shares. So first here is authorized share capital. So what is here authorized share capital? Here the maximum amount of the capital that can be issued by the particular company is known as authorized capital. Here the company can increase their permissible limit to authorized share after they have availed permission from the respective authority and have paid the required fees. So here in simple words, authorized share capital is the capital which is required by the company during the starting, or you can say that it is a maximum amount that the company need. So how much ever capital it need, it issues a certificate or it issues the shares according to that. Now suppose like a company needs a capital of 1 crore. So that is they issue the shares worth of rupees 1 crore, that is your authorized capital. So it is a maximum amount they can issue in the form of that is they can issue to they can issue by the particular company which is known as a authorized capital. That is a maximum amount where they collect in the form of by issuing the shares. Then this authorized capital can be increased by with the special permission, and they have to pay some nominal fees to get in permission to increase their authorized capital. Then issued share capital. So the shares which a company offers to an investors are known as the issued capital. So in our yesterday's example we have seen, so the 5,000 shares were available to the general public, right? So here 5,000 are the share which are issued by the company to the general public. That is general public has an option to purchase the shares in a company. So these are the issued share capital. So here we can say that issued share capital are the shares which the company offer to the general public. Then next is subscribed. It comprises of the part of issued share capital which the investor agree upon and accept. Subscribed share means what here? The investors who are willing to purchase. So we have seen that totally the company is offering the 5,000 share. So a person or an investor can't buy all the 5,000 share. So out of 5,000 share, I may be willing to purchase some 50 shares or some 100 shares or 200 shares. So how much ever I am willing to pay, that I will approach to a company. So that is called here as a subscribed capital. So in short, we can say that it is investors who agree and accept to subscribe the share or to buy the shares of the company. Next, right shares. The shares that are issued to the individual after they have invested in equity shares are known as right shares. They are issued to safeguard the existing investors' ownership. So here after the subscription by the investors, those shares are here issued to those individuals who are investing. So these are known as a right shares. So these are issued for the safeguard, that is it will safeguard the interest of the investors, which specify that their amount is being invested in the company and they are safe. Then next is sweat equity shares. So as an appreciation for the job well done, a company reward their employees or the director with the shares. Such shares are known as sweat equity. So here, whenever a company do an excellent job, or because of the management and because of the employees with their hard work and effort, the company has gained more profit, or it has been raised, or there has been appreciation in the company, then here company in return will issue some share to the directors and the investors, those who are holding the shares. So it is a reward which is given to the employees or the director. So it is called as a sweat equity, that is it is a reward what is being paid for the hard work of the management and as well as the workers. Then next is paid up capital. Then it forms the part of subscribed capital which the company invests in their business. That is subscribed shares, that is the company, that is the investor, they want the shares, that is they approach for the shares. If they are purchasing the shares, then they have to pay into the stages, that is allotment, that is, so first is application, then next is allotment, then first and final call. So out of those calls, that is out of those stages, whichever the investor have paid, already paid, that is called here as a paid up capital. So in short, we can say that the amount which is already paid by the investors is a paid up capital. Then next here is bonus shares. So these are the shares issued to the investor in the form of dividend. So these are the shares which the company will issue to the investors in the form of a dividend, that is whenever the company is declaring the dividend, that is return on the investment, then with along with the dividend, or instead of giving the dividend, they issue them some more shares. So as we know that the dividend is a return what the investor get whenever the company earn profit. So instead of giving certain percentage from the profit, they give them shares itself, so that they can have a more number of the shares of the company. Then next coming to the preference shares. So these are the shares which are preferred over equity shares in the payment of dividend. The preference shareholders are the first to get the dividends if the company decide to distribute or pay the dividends. So the second type here is preference shares. So by the name itself we can identify the meaning, that is preference is giving the priority. So here whoever is holding the preference share of the company has some preferential rights. So here whenever the company declares the dividend, the first dividend is paid to the preference shareholders, then comes to equity shareholders. So at the time of dividend declaration, preference shareholders are the first to receive the dividend, that is a part of a profit is first received by the preference shareholders. Then here, coming to its features, preference shares are the shares having the preferential rights to claim dividend during the lifetime of the company and to claim the repayment of the capital on the winding up. In such case of a preference shares, the percentage of dividend is fixed. The holder get the fixed dividend before any dividend is paid to the other class of the shareholders. So here when we have seen to the share capital, whenever the person is that investor invests in the shareholder, that is equity shares, the dividend depends on the profit. That is, if the profits are higher, then the equity shareholder is going to get the highest return, and if it is low, then he is going to get the lowest return. But in case of the preference share, the rate of dividend is fixed here. That means what here, company either it earn the profit or it is incurring the loss, but the returns whatever it has to pay to the preference shareholders is fixed here. So the rate of dividend will be fixed. So whatever may be the situation here, they get a fixed type of returns. The advantage of this is whenever the company is making little low profit, it doesn't make any difference to the preference shareholders. Why? Because they are going to get a fixed return. But the disadvantage is whenever the company is making the higher profit, they are not going to earn any extra returns. They are going to get the returns same as it is fixed. So here preference share has they have a right to claim the dividend during the lifetime of the company, and they can when the company is winding up, that is when the company is closing, they are the first persons before the equity shareholder to get back their money. Then here preference shares are important source of hybrid financing. So it is called as a hybrid finance because preference share is a mixture or the combination of equity shares as well as some of the features of debentures. So what is here debenture? You will be knowing it in the later part of this topic. So here when we talk about the preference shares are here the combination of equity shares and some part of the debentures. So the preference shareholders will enjoy some rights with regard to the receiving of dividend and getting back of the capital in the case of winding up. So as I have said that during the winding up of the company, here the preference shares are given first priority before the equity shareholders, and the dividend whatever they are getting in return will be fixed. But the disadvantage for the preference shareholder here is they do not have any voting right, or their decision is not taken into the consideration during the time of any decision in the matters of the management. So here equity shareholders are not given any voting right or the powers in the affairs of the company. Then next coming to types of preference shares. So the first type is here is convertible and non-convertible preference shares. So here convertible preference shares are those shares which are converted into the equity shares within the certain period. That is, the shares which the equity shares can be converted into the preference shares. But here they have an option or the right wherein the ordinary shares are converted, that too with some agreed terms and conditions. And non-convertible shares, they do not have any option so that the shares can be converted. So they do not carry any right of conversion into equity shares. Then those are called as a non-convertible preference shares. So here in simple word, convertible means here the preference shares can be converted into the equity shares, and non-convertible is that the shares do not have any right of conversion into the equity shares. Then next coming to the redeemable preference shares and irredeemable preference shares. So here redeemable preference share has a maturity date on which date the company will repay the capital amount to the preference shareholders and discontinue the dividend payment. That is, whenever here the person or the investor is investing into the business, or when he purchases the preference shares, that will be up to the certain period of time. So once if the time get over, that is whenever that maturity date comes, the company will return back that preference shares, and those will stop giving them the dividend on that. So irredeemable preference share that do not have any maturity date, the dividend of these shares are fixed. So that is whenever the preference shareholder purchases the preference shares here, those do not carry any maturity date. So that is we can consider here that will remain up to the winding up of the company, that is till the closure of the company. So till that the dividend will be paid on that. So here in case of redeemable preference share, those will have a maturity date, that is up to till the certain period of time those capital will be in the company, and after that that will be returned back to the preference shareholders. Then next is here participating and non-participating. So here participating preference share has an additional benefit of participating in the profit of the company apart from the fixed dividend. That is here the preference share enjoy some other rights in the capital, that is they receive some extra part from the capital apart from their fixed dividend. So as the preference shareholders, they have to receive some of the fixed dividends, but apart from those fixed dividend, they even get a share in the profit. Then next, coming to the participating, that is they do not participate in the other matters, that is they receive only the fixed dividend. Then next here is cumulative and non-cumulative. So cumulative shares, the dividend are accumulated and therefore paid before anything paid to the equity shareholders. So here cumulative means what? Whatever the dividend is given to the preference shareholders, they go on accumulating, that is the amount goes on accumulating and they are paid first to the preference shares before they pay into equity shares. That is the amount is gathered here and finally that will be paid to the preference shareholders. Non-cumulative means here the company doesn't pay dividend in the current year. If the company does not pay dividend in the current year, the claim of preference share is lost to that extent. That means if in a particular year the preference share is not declared, then that preference share is not carried to the next year. That is, last year you have not paid the preference share, so this year you can pay the preference share. This is not the case in non-cumulative. If that year, particular year, if the preference share is not paid, then that will be not paid in the next year. That is, there is no carry forward of the dividend in the next year. But wherein the cumulative, that has a carry forward. That is, if the dividend is not paid in the previous year, then the company has to pay it in the next year, including the present year and the previous year. But in the non-cumulative, it has like only the current year is paid, and that cannot be claimed back. So if it is not paid in the this year, then it is lost. Then next is the last step here is share with callable option. That is, a company has a right to redeem preference share in between. That is, it can take out its preference shares. Such preference shares will be redeemed at the premium if the redeemed is in between. That is, whenever the company wants to take out, that is during the maturity, it has to take back its shares. That is, the investor, if they want to take back the shares, then the company has a right of that, but along with the premium. So the company will exercise such option if the rate of preference dividend is falling in the market. That is, if the rate of the preference share is falling down in the market, that is the rate of dividend is very less in case of the preference share, then only the company will give the option to take back the preference share, but that too along with the premium.